to give you 3 keys to great swing trading setups, but these 3 keys can really be applied to any setup that you want to apply to, whether it's going to be a day trade, whether it's going to be something longer term. Now, the first thing that you're going to look at in your setup is going to be the depth of that setup. You're going to want to see, is it reasonable given the pattern that you're looking at? Let's say that you're looking at a cup with handle, right? And you've studied that cup with handles should be 35% deep, no more than about 35%, maybe 40% at a stretch. Given the kind of crazy market that we've had, you might go to as much as 40% deep. So keep that in mind when you're looking for these setups, because there's plenty of setups that look like they have the essence of your cup with handle, something that looks kind of like this, right? Where you have the cup and then you have the handle like that. But if this happens to be, say, 60% deep, that's too much. If the handle happens to be 15 or 20% deep, now the handle is starting to become its own base pattern, and it's not something that's going to be playable for you. Right? Like if you're familiar with this pattern, well, with this cup and handle pattern, and that handle right there is 20% deep, you need to place your stop loss down here. You would look to enter above it right there, and if that's 20% deep, then just for this to be a one-to-one trade, you would need to make at least 20% on that trade. That's asking a lot. So depth is a factor. You want your trades, your setups that you're going to take, to be nice and tight, because the tighter that they are, the less the stock has to move in order for you to make bank on it. Just a quick example, if the depth of that handle, let's say, was only 5%, then if it moves 15% or 20%, then you'll be making 3 times your money, 4 times your money just on that simple move, as opposed to this being 20% deep and it moves 20%. You risked $1 to make $1. Not the best trade. Next thing that you need to look for is the width of the pattern. Now, if you're just to stick with this example here, your standard cup with handle, you're going to be looking for it to be at least 7 weeks long. If it's less than that, if you're looking at a 4-week or a 3-week and it happens to have the essence of a cup with handle, the essence of it's there. Like, it might look like a cup with handle, but is it something that's going to produce that bigger move? Where if you've studied, say, William O'Neill, and you've read his book, How to Make Money in Stocks, and you're like, wow, the cup with handle is supposed to be 7 weeks long, understand that he's looking to hold that for several months, possibly even a year or longer. And if you have a setup that is much shorter, say 3 weeks, then you're not going to have that kind of a move. So it's starting to set the expectation of how long you're going to hold this trade. If the base pattern has been setting up for many months and starts to break out, then you would have the expectation that this is going to be a breakout that's going to last for several months. If you're looking at a intraday chart, let's say you're a day trader and you're looking at a 3-minute chart and it's setting up, then you're only going to be looking at holding this position for a few minutes, maybe an hour, tops, if it continues to run up. It's taking it all into context, being aware of the width, the amount of time that it's been consolidating, that it's been trading sideways, and that will help you figure out how long your holding period should be. Last part, the character. And the character that you're looking for, it's not going to be Mickey Mouse. What you're going to be looking for is, do you have a pattern that's been kind of wide and loose, and then it starts to tighten up, and then it starts to tighten up some more? That's what you're looking for. You want to see volatility contract as the pattern is going from the left side of the base to the right side of the base, because it's kind of like this spring that's coiling up and coiling up and coiling up, and then when it finally does break out, you've got a pretty long base here, right? You've got 9 bars altogether, well, whatever time frame that you're looking at. 9 bars is 9 bars. Then you also have this character where it's tightening up, tightening up, tightening up, and the depth overall, you're looking back here, and rather than having to, let's say that this is 20% and this is 10% and this is 5%, you don't have to have, if this moves 20%, it's not going to give you $1 for risking $1, right? It's not risk 20%, make 20%. Now it's risk 5%, make 20%, because you're going based off of this back here. So that is the thing that is going to give you that high probability, high reward to low risk setup that we love to see. And that's why it's a key element of the system that I've developed for myself called Eagle. And that the A in Eagle is for aiming for these kind of setups. High probability, high reward to low risk. And those are 3 keys to great setups in any pattern that you're looking for.